Today I'm going to talk about the Savers Credit for 2022, so you can save on taxes and retirement at the same time. Now I'm going to start with a brief explanation on credits versus deductions, just so you can see the differences and figure out how those work. Then I'll jump into the Savers Credit. Then we're going to talk about the income limits for the Savers Credit. And finally, an example so you can really understand how to use the Savers Credit and probably qualify for more tax credits and deductions than you thought possible. So let's go ahead and get started with the credits versus deductions. So here we have tax credits versus tax deductions. With tax credits, these go against your total tax liability, where tax deductions reduce your total taxable income. So let's use an example so you can see how this works. Let's say that we're single, earning $50,000. If that's the case, our total tax liability is going to be $6,617. Now let's assume that we have a $2,000 tax credit. What this means is it's going to reduce your total tax liability. So we can subtract $2,000 and end with a total tax liability of $4,617. On the other side, with tax deductions, it works a little bit differently. We have the same $50,000, assuming that we're filing as single. A $2,000 tax deduction would reduce our total taxable income by $2,000, bringing our total taxable income down to $48,000. On $48,000, your total tax liability would then be $6,177. So with a tax credit, we were able to reduce our tax liability by $2,000, but with a tax deduction, our total tax liability dropped by $440. So I just took the $6,617 and subtracted the $6,177. That's how I got the $440. So the Savers Credit is, you probably already guessed it, a tax credit. Now, the way that it works is by making a contribution into your retirement plan, whether it's a 401k, 403b, SEP, simple, traditional IRA, Roth IRA, any retirement plan. Making that contribution into the retirement plan could possibly qualify you for this tax credit based on your filing status and your income. Now, the credit is up to $1,000 and up to $2,000 if you're married filing jointly. And it's based on up to $2,000 of your contribution. So the maximum that you could qualify for is making a $2,000 contribution into your retirement plan, and the maximum that credit would be 50% of that amount, which would equal $1,000. So let me go ahead and pull up the numbers on the income limits, and you're going to see how it qualifies based on your filing status, your income, and the amount that you're going to contribute into your retirement plan. So here's the IRS's website with the Savers Credits limits, the income limits, and this is for 2022 right here. So the 2022 Savers Credit. And what we see is 3 columns here. So we have married filing jointly, we have head of household, and all other filers. That would be for those filing as single. And over here, we have the credit rate. So let's say, for example, that we're married filing jointly. If your adjusted income is not more than $41,000, then you would qualify for up to a 50% of your contribution. So what I was saying before was, if you make a $2,000 contribution, 50% of $2,000 is going to be $1,000. Now, that is the maximum that you could possibly qualify for. But if your income goes higher, let's say it's $67,000 as married filing jointly, that means you would fall under this bracket right here, and it would equal 10% of your contribution. Or if you made a $2,000 contribution, 10% of $2,000 would be $200. That is a tax credit. So $200 back in your pocket by making that contribution into your retirement plan. But depending on your retirement plan, you could possibly also qualify for a tax deduction. And that's why I went over credits and deductions at the beginning of the video, because by making a contribution pre-tax into, say, your 401k, 403b, or traditional IRA, then you would reduce your total taxable income, as well as possibly qualify for the tax credit. So it's almost like you're double dipping and getting way more benefit than you probably thought in the beginning. So let's say that your adjusted gross income is $42,000 and you make a $2,000 contribution to your 401k at work. That means we're going to reduce your adjusted gross income to $40,000 because you've made that $2,000 contribution. So if we look to the chart right here for married filing jointly, below 41,000 is a 50% credit up to $2,000. So that $2,000 contribution will give you a tax credit of $1,000. So you're saving $1,000 in taxes and you're putting $2,000 into a retirement plan. But if it's a retirement plan at work, then you could also possibly get a match from your employer. So with the Savers Credit, you can get a tax deduction, a tax credit, a match, and put away money for retirement. And don't be fooled by the adjusted gross income, because you can earn significantly more and get that income down in order to qualify. So you can actually put away up to $61,000 into your retirement plan, especially for a small business owner, and double that if you're married filing jointly. So here's what this math looks like for those super savers out there. So if you can put away up to $61,000 and you're married filing jointly, that means you can get a tax deduction up to $122,000. Now that Savers Credit, that 50% threshold for the income, $41,000. That means you can earn up to $163,000 and potentially still qualify, of course, if you're a super saver. And if you're 50 or older, that's $67,500 multiplied by 2, that's $176. $41,000 more, bring the total amount to $217,000 for those super savers. So that is the Savers Credit. So go out and start saving, figure out what you can qualify for. And if you have any questions on the Savers Credit, let me know in the comments down below, and we'll see you on the next one.